Dollar cost averaging is a strategy to reduce the impact of volatility by spreading out your stock or fund purchases over time so you're not buying shares at a high point for prices. Dollar cost averaging is the strategy of spreading out your stock or fund purchases, buying at regular intervals and in roughly equal amounts. When done properly, it can have significant benefits for your portfolio. This is because dollar cost averaging smooths your purchase price over time and helps ensure that you're not dumping all your money in at a high point for prices. Dollar cost averaging can be especially powerful in a bear market, allowing you to buy the dips or purchase stock at low points when most investors are too afraid to buy. Committing to this strategy means that you will be investing when the market or a stock is down, and that's when investors score the best deals. That is a quick overview on the whole topic. But before we get into it, please don't forget to like and share this video with friends, and also hit the notification bell to stay updated. Dollar cost averaging (DCA) is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. The purchases occur regardless of the asset's price and at regular intervals. In effect, this strategy removes much of the detailed work of attempting to time the market in order to make purchases of equities at the best prices. Dollar cost averaging is also known as the constant dollar plan. Understanding dollar cost averaging (DCA). Dollar cost averaging is a tool an investor can use to build savings and wealth over a long period. It is also a way for an investor to neutralize short-term volatility in the broader equity market. A prime example of dollar cost averaging is its use in 401k plans, in which regular purchases are made regardless of the price of any given equity within the account. In a 401k plan, an employee can select a predetermined amount of their salary that they wish to invest in a menu of mutual or index funds. When an employee receives their pay, the amount the employee has chosen to contribute to the 401k is invested in their investment choices. Dollar cost averaging can also be used outside of 401k plans. Additionally, many dividend reinvestment plans allow investors to dollar cost average by making contributions regularly. Real-world example of dollar cost averaging. Joe works at ABC Corp and has a 401k plan. He receives a paycheck of $1,000 every 2 weeks. Joe decides to allocate 10%. The average was higher than his initial purchase, but it was lower than the fund's highest prices. This allowed Joe to take advantage of the fluctuations of the market as the index fund increased and decreased in value. How dollar cost averaging works. It is important to note that this example of the dollar cost averaging strategy works out favorably because the hypothetical results of the S&P 500 index fund ultimately rose over the period of time in question. Dollar cost averaging does improve the performance of an investment over time, but only if the investment increases in price. The strategy cannot protect the investor against the risk of declining market prices. The general idea of the strategy assumes that prices will, eventually, always rise, because the strategy may encourage an investor to continue buying more stock at a time when they should simply exit the position. For less informed investors, the strategy is far less risky on index funds than on individual stocks. Investors who use a dollar cost averaging strategy will generally lower their cost basis in an investment over time. The lower cost basis will lead to less of a loss on investments that decline in price and generate greater gains on investments that increase in price. What is dollar cost averaging? Dollar cost averaging is an approach to investing that involves periodically investing a set amount of money regardless of the market price of the securities being purchased. It is often associated with passive investing strategies in which the investor wants to minimize the time they must spend in administering their portfolio. Although dollar cost averaging can be applied to all types of securities, it is most commonly used in relation to pooled investment vehicles such as mutual funds, index funds, and exchange-traded funds, ETFs. Dollar cost averaging, known as DCA, can be a great alternative to investing a lump sum. Instead of investing all of your capital in one go, the idea is that you invest smaller, fixed amounts on a regular basis over an extended period of time. For example, instead of investing $6,000 in one transaction, you could invest $1,000 per month over 6 months. The price of the asset you're buying may go up and down over that period, but you always invest the same amount. What happens is that you end up buying more of the asset when the price falls in any given month, and fewer units if the price is higher. You might have heard the saying that timing the market is more important than timing the market. This is where DCA comes in. You may want to buy more shares when the share price is low, but timing the market to find the bottom of the dip is very difficult, even for experienced investors. Or perhaps you've been saving enough money to buy your first bundle of shares, and by the time you have enough, the share price of the stock you're wanting to buy has steadily increased. Dollar cost averaging alleviates the need to find the bottom or top of a share price. Dollar cost averaging can in some cases take away the timing risk of trying to pick the bottom of a market and can possibly offer benefits in volatile or hard-to-predict markets when investing a lump sum can be rather nerve-wracking. Why do some investors use dollar cost averaging? The key advantage of dollar cost averaging is that it reduces the effects of investor psychology and market timing on their portfolio. By committing to a dollar cost averaging approach, investors avoid the risk that they will make counterproductive decisions out of greed or fear, such as buying more when prices are rising or panic selling when prices decline. Instead, dollar cost averaging forces investors to focus on contributing a set amount of money each period while ignoring the price of each individual purchase. What is an example of dollar cost averaging? An example of a dollar cost averaging approach would be investing $500 per month in an index fund that tracks the performance of a broad market index, such as the S&P 500. In some months, the index will be priced high, meaning fewer shares would be purchased for the $500 investment. In other months, when the index is low, $500 would purchase a greater number of shares. In the long run, however, investors who use a dollar cost averaging strategy are betting that the simplicity of the strategy, combined with the fact that it protects them from the temptation of buying high and selling low, will ultimately lead to better results than trying to time the market on each purchase. Drawbacks of dollar cost averaging. The two downsides of dollar cost averaging are modest. First, buying more frequently adds to trading costs. However, with brokerages charging ever less to trade, this expense becomes more manageable. Moreover, if you're investing longer-term, fees should become very small relative to your overall portfolio. You're buying for the long haul, not trading in and out of the market. Second, by dollar cost averaging. However, the success of that large purchase relies on timing the market correctly, and investors are notoriously terrible at predicting the short-term movement of a stock or the market. If a stock does move lower in the near term, dollar cost averaging means you should come out way ahead of a lump sum purchase if the stock moves back up. Who should use DCA? Dollar cost averaging is ideal for long-term investors. The goal is to stick to an investment cycle where a fixed amount is consistently invested in an asset. There is no room for doubt, greed, or fear associated with short-term investment strategies. It is also worth mentioning that dollar cost averaging is more effective in a bear market. While most investors are too afraid to buy, always wondering if they are too early or too late to the game, your dollar cost averaging plan would provide you with an investment framework for buying the dip. Now that you know the fundamentals of dollar cost averaging, let's take a look at the possible effects of this strategy in various investment scenarios. Hope this guide is useful to you to decide which is better for you, debit or credit card. Please give this video a thumbs up, subscribe to the channel, and comment below your thoughts or questions. Thank you for watching. Until next time.